What is actually the best way to start investing from zero? This is one of the most common questions I get now, especially when everyone is shouting about stocks, crypto, gold, property, bonds, in a time where the investing landscape has changed a lot over the last year. I built up over £500,000 in investments using real accounts, real tax rules, and methods I've actually stuck with for years. No rented Lambos or get-rich-quick nonsense, just what has worked and what has not, and why. In this video, I'm going to brutally rate every major way to invest based on three things that actually matter: the realistic return potential, the level of risk you're taking, and how suitable it is when you're starting out. I will also show you my real numbers for each so you can see where my money actually is. By the end of this, you'll be able to decide what makes sense for you. So let's start with individual stocks. At the most basic level, stocks are the building blocks of the entire stock market. Every index fund or ETF, which we'll talk about later, is made up of lots of these individual companies. And this is where investing starts to feel exciting. You buy a company, you watch the price move, you see it go up or down in real time. There's a real sense of ownership, and when a stock does well, it feels genuinely rewarding, and when it goes the other way, you feel that too. A lot of people have done fairly well with individual stocks, especially early on, because they tend to buy companies that they already know and like. Brands like Apple, Microsoft, and Tesla, big household names, are benefiting massively from the growth in technology over the last decade or so, and it's definitely given the illusion that it's easier than it is. But this is also where things start to get a bit more nuanced. With individual stocks, there's a much higher skill level involved. Doing it properly, you should be looking at things like company financials, having some sense of valuation, being patient when prices move against you, and not letting emotions drive every decision you make. One of the most common mistakes beginners make here is assuming that liking a product automatically makes it a good investment. Great companies are not always great investments, especially if you overpay or put too much of your money into just one or two names. Some people are really bullish on tech and AI, and they have done really well, and I imagine they will do well into the future too. But you need to remember that a lot of that value can already be in the price. Personally, I do enjoy holding individual stocks. If you look at some of my biggest positions like Rolls-Royce, Google, and Tesla, a few of them have returned some really impressive numbers over time. I've also had much better experience with US stocks compared to some of the more traditional UK shares in the past, where I decided to play it safe and ended up with fairly average results. I look back at my times where I bought things like Barclays and think, what in the world was I thinking? Admittedly, they've done way better recently, but in this period back here, it was pretty nasty. That said, individual stocks still make up a relatively small part of my overall portfolio. I do enjoy them, I like following companies, and I stay very aware of the risk and the skill involved. So let's talk about how these score. Well, on return potential, they score high. There is genuine upside here, but there's also the downside of zero. And when I put zero here, I don't just mean you make nothing. I mean your money could literally go to zero if you're reckless. On tax efficiency, they can be excellent if you hold them within a stocks and shares ISA, and on a skill level, they score high. You need to be careful and pick the right companies, which isn't easy or everyone would be doing it. And on risk, they're also high because single companies can underperform for long periods of time. Admittedly, it depends on your view of where you think the future is. Some people would class tech as a very low risk, but I think it would be silly to say that here. This is why, for me, individual stocks is something I enjoy and use selectively, but not something I would build an entire portfolio around. Now, if you do want to buy individual stocks, the platform I personally use is Trading 212. They have a £0 commission on buying and selling shares. It's nothing to open an account, and you can hold everything inside a very tax-efficient stocks and shares ISA. They also offer something called fractional shares, which means you don't need to buy a full share in companies like Apple or Tesla. You can start with a much smaller amount and build from there. And if you want to try it out, you can get a free fractional share with up to £100 by using my link in the description or entering code Chris when you sign up. You can even do this when you've already got an account open to try and claim that free share. As always, there's no rush. The goal here is understanding your options first, then deciding what actually makes sense for you. After stocks, if you want something more low risk, you could keep your money in cash instead. Now, cash is a funny one because I actually don't think cash is as low risk as people think. For the return potential of cash, I would give it -3 to 4%. That'll surprise a lot of people, but what I mean by that is on the upside, you can get a good 3 or 4% if you're in a right type of account getting a good rate. Now, the negative number here comes from the fact the rate you are advertised isn't technically the rate that you're going to be getting. That's because you need to factor in inflation here. If inflation is 3% and you've got 4% on your cash, you've effectively made 1% in that year. That's because inflation makes the cost of everything more expensive, so your £1,000 in savings today, if it's still £1,000 in savings in 1 year's time, wouldn't have the same spending power. So if you had £1,000 in an account getting 0%, which happens a lot as banks love to not pay us a good rate of interest and pocket it themselves, you effectively get -3%. The tax efficiency of cash is medium. It's great if you have it within an ISA, and not so great if you don't, because our savings allowances have been slashed. So the amount you can earn without paying tax on interest has actually been reduced dramatically. There's no skill required other than opening an account, and the risk is also very low, unless you consider the negative number that I just mentioned. The way I look at cash is it's great for an emergency fund and your day-to-day spending, but it's just not a good long-term investment. The same inflation is true about every method I mentioned here, by the way. You have to be beating inflation or you're essentially just leaking money. One alternative, if you need a more tax-efficient wrapper, is something called premium bonds, where you can earn prizes tax-free. These are very fun in the sense that you can win a prize every month, but the returns tend to often underperform what you would get just having the money in the bank. The real benefit of them is that that prize is tax-free because it's a prize rather than interest, but not something you should rush to open unless you fit into a very niche bracket and you've used your other tax wrappers. Before we move on, I want to say a huge thank you to the sponsor of today's video, 21 Shares. There's something a lot of people have completely missed. For the first time in the UK, you can now get crypto exposure inside a stocks and shares ISA, which makes any gains tax-free, or inside your SIP, where the growth is tax-free and you get tax relief on the money you put in. And I'm not talking about unregulated crypto apps or meme coins, I'm talking about the new crypto exchange-traded notes on the London Stock Exchange. They behave almost exactly like ETFs. They're just another type of exchange-traded product. You can buy and sell them through your normal investment platform and inside an ISA or a SIP, so they fit into the same tax-efficient structure as your other investments. That's a huge shift, because until now, if you wanted exposure to Bitcoin or Ethereum, you were pushed outside of all of the tax-efficient wrappers and immediately had to deal with capital gains tax. Now, if your platform supports these ETNs, that problem goes away. And one of the biggest names behind this is 21 Shares. They've been offering fully physically backed Bitcoin and Ethereum ETPs across Europe for years, long before the UK allowed retail investors to get access to them. All of their ETNs are physically backed in cold storage, which is a requirement mandated for any crypto ETNs in the UK. They've also put together some really clear resources, explain the structure and the risks, which I've linked down below. Just remember that crypto is high risk and you can lose all of the money that you invest. Make sure you understand the risks properly, and you can learn more at 21shares.com. Okay, so if you don't want your money sat in cash long term and you're a bit put off by the ups and downs of individual stocks, the next option is index funds. And this is where, for most people, investing actually starts to make a lot more sense. An index fund is simply a fund that owns a lot of companies at once. Instead of trying to pick a winners by yourself, you're buying a small piece of the entire market or a selection of it. So rather than owning Apple or Microsoft on their own, you might own hundreds or thousands of companies in one go. This is important because it massively reduces the risk of any single company ruining your results. And this is why I said earlier that individual stocks are the building blocks. Index funds and ETFs are just baskets made up of those blocks, spread across different companies, sectors, and sometimes different countries. Now, the big advantage of index funds is that you're not trying to outsmart anyone. You're simply just riding along the growth of the global economy. And historically, broad stock market index funds have returned somewhere in the region of 7 to 10% per year over long periods of time. It's not every year. Some years are great and some years are awful, but over time, that's the kind of return that people have seen. The common mistake people make with index funds is thinking that they're boring or slow, and then underestimating how powerful consistency and compounding really are. A 7 or 8% return might not sound exciting, but over 20 or 30 years, it could be the difference between having to work forever and having real financial freedom. With index funds, the skill required is much lower than picking individual stocks. You don't need to read company accounts, predict which sector will win next, or react to every bit of news. The hardest part is actually doing nothing and then sticking with it when the markets fall. That does not mean that there's no skill involved at all. You still need discipline and patience and the ability to stay invested when things feel uncomfortable, but compared to stock picking, it's far more forgiving. For me personally, this is where the bulk of my money is. The vast majority of my portfolio sits in index funds and ETFs, and at the moment I actually have over £400,000 invested in this way. Not because it's exciting, but because it's been reliable, tax efficient, and it's something I can actually stick with for the long term. And this is where tax efficiency really shines. Held inside a stocks shares ISA or a pension, index funds are incredibly efficient. No capital gains tax, no dividend tax, and very little ongoing admin. That alone makes a huge difference over time. So when you add all of that up, this is how index funds score. On return potential, they score high because of the long-term economic growth. On tax efficiency, they score very high, held within an ISA or a pension. On a skill level, they score low. You don't need to be an expert to do well here. And on risk, they sit in the medium to low range. Markets go up and down, but you're not betting on any single company. That is why if someone was to ask me where to start investing from zero in a calm, sensible way, this would be my answer. It's not flashy or exciting, just something that works if you have enough time. There's loads of great platforms you can use for these. I'll pop them all down below with any bonuses they offer to make things easier for you. The next type of investment is property, and this is probably the one I get asked about more than anything else. Property investing has been popular for decades, especially in the UK. It's been seen as a solid way to build wealth because on paper you get two things at once. You get rental income coming in each month and an asset that hopefully increases in value over time. And to be fair, for a long time that worked very well. If you look back at the numbers, the UK housing market really has climbed a long way. In 1980, the average house price was about £20,000. By 1990, it was nearly £60,000, and since 1980 overall, prices have risen more than 1,100%. Even over the last 20 years, prices have almost doubled, and if you go back to the mid-70s, prices have risen by over 2,300% to today's levels. A lot of people built serious wealth through property during those periods, but the environment today is very different. House prices are much higher relative to incomes, interest rates are higher than they were for most of the last decade, and running costs have been increased, and at the same time renting has become more complex. Landlords are facing more regulation, higher taxes and higher costs. None of these things are necessarily wrong, but they do change the maths. And I think it would be fair to say that governments are pretty anti-landlord. For me personally, when you add all of that together, property has become far more hands-on and far less forgiving than it used to be. You're dealing with maintenance, empty periods, managing tenants, unexpected repairs, and the risk that one big issue like a problem with a boiler or the roof can wipe out a year's worth of profit or even more. And when I compare that to something like index funds, which quietly compound in the background with almost no admin, I do question whether the trade-off is worth it for most people starting today. That said, property is not a one-size-fits-all. There are still ways people make it work very well. One alternative is a real estate investment trust, which lets you invest in property through the stock market. You get exposure to property without dealing with tenants, repairs, phone calls, or awkward times. You just get paid out a return. And held inside with an ISA, this can actually be more tax efficient. Now, another option is buying a property through a company structure, which can improve the tax position in some cases, though it comes with its completely own set of costs and complexities. And there's also a big exception that I always like to mention. If you already have a skill that can reduce costs, property can look very different. I've seen this firsthand in my dad's industry, plumbing, where people bought properties, did a lot of the work themselves in their spare time, and they filled gaps in labour without paying retail rates. So for example, if you've got a couple of days spare that week, you can go or work on the property. And when you can control costs and spot problems early, property becomes far more efficient because it's a skill advantage, not just the norm. And from experience, it's extremely expensive to get anybody to do anything these days. Most people I know who've had properties are unfortunately selling up. Equally though, I think the demand for houses is much higher now with less landlords, so the ones who do stick around may be the ones benefiting. I think the whole anti-landlord regime actually goes against people who have to rent in the first place, because people have got to rent houses at the end of the day. So when you add all of that up, this is how property scores for me. On return potential, I would put it in the middle. There's upside, but after costs and taxes, it's often lower than people expect. On tax efficiency, it's weaker than it used to be, unless you're using structures like company or REITs inside an ISA. On a skill level, it's medium to high. You're running a business, not just making an investment. And on risk, I would also put it on the higher side because of leverage and regulation, and unexpected costs can have a big impact. That's why for me, property is something I respect the people who do it, but something I personally probably wouldn't prioritize when compared to simpler, lower stress options like index funds. The next type of investment is gold, and gold is one of those assets that everyone has an opinion on, and over the last year, gold has done incredible, so of course people have got questions. Now, some people swear by it and some people hate it, and some people buy it just because it feels safe, and it's got people thinking, well, should I be owning some? Well, historically, gold has been something of a store of value, something you hold to protect purchasing power, especially during periods of inflation, uncertainty, or when confidence in currencies and governments is low. And to be fair, there's been periods where gold has done exactly that. If you look at gold since the year 2000, it's actually had a really strong run. On average, it's delivered around a 10.9% annual average return between 2000 and 2025, which is huge. But this is where you have to be very careful because gold is very period dependent. It can have great decades and it can also have really long stretches where it goes basically nowhere, sometimes for years at a time. For example, gold peaked around 1980. If you bought that near the high, then it basically went sideways for almost 20 years. In nominal terms, you did not get back to those levels until around the year 2000, and in real terms, after inflation, it took even longer. That is a long time to hold something that's not producing any income, and this is why it's important to be honest about gold and what it actually is. Now, gold doesn't produce an income, there's no dividends, no rent, no cash flow. Your return purely comes from the price moving, which means your outcome depends heavily on when you buy and sell. Another reason that people like gold is there's supply story. So gold is scarce and new supply comes on slowly. The World Gold Council estimates mine production has been adding around 1.8% per year to above ground gold stocks over the past decade. So it's not like somebody can just double the supply overnight. Now, tax is also a big one in the UK, and this is where people sometimes miss a trick. If you buy gold in the form of UK legal tender, coins like Britannia's or post-1837 sovereigns, HMRC treats these as sterling currency, and they're exempt under the relative capital gains rules. That can make gold far more tax efficient than people realise if you compare it to holding bars or non-sterling coins outside of a tax wrapper. The mistake people often make with gold is treating it like a growth engine that will always perform. Gold can play a useful role, but it's better thought of part of a diversifier in a form of insurance rather than the thing you rely on to build wealth. It can shine in some environments, and it has over the past 25 years, but it's not guaranteed to compound like productive assets do. It depends in which period you buy it in. So when you add all of that up, this is how I would score gold. On return potential, I would put it in the low to medium. It can do very well in certain periods, but it's not consistent year to year. On tax efficiency, it can be strong if you use the right vehicle, like an ISA wrapper for an ETF or UK legal tender coins. On skill level, it's low to medium, depending on whether you're going to try and time the market with it. And on risk, I would put it low to medium. It can swing, but you're not dealing with business failure or tenant problems. This is why I see gold as an optional diversifier and not a core building block. It's useful in the right context, but not something I would start prioritizing when starting from zero, and personally I don't own any right now. The next type of investment is crypto. Crypto is very much a Marmite asset. Some people absolutely love it and some people want nothing to do with it. And most people sit somewhere in the middle thinking, should I own some or am I mad for even considering it? The first thing is to say that crypto is not one single thing. There's thousands of crypto coins out there, many of which are highly speculative and will probably not exist in a few years' time. And there are some more established names like Bitcoin and Ethereum, which tend to be what people actually are referring to when they talk about crypto as an investment. I think you've got crypto and then you've got Ethereum and Bitcoin. This distinction really matters. Crypto could feel exciting for the same reason stocks do, but amplified. Prices move quickly, stories travel fast, and it often feels like everyone knows someone who bought in early and did incredibly well. And that's where a lot of the FOMO comes from, and that FOMO is where people usually go wrong. The biggest mistake I see with crypto is people either going all in or buying random coins simply because someone down the pub told them to, or because they saw a big move on social media, and that's not investing, that's just gambling. And there's a big difference between taking a small, deliberate portion in something long-term and chasing hype. And one thing I do think that's worth saying for some people is that having a very small allocation to crypto can actually reduce that FOMO. Instead of feeling like you're just missing out, you have some exposure and you understand how it behaves, and you're less tempted to make emotional decisions. You don't want to look back in 20 years' time and think, oh, why didn't I just buy some Bitcoin when everyone was talking about it? Crypto has also changed a lot over the last few years. It's become far more mainstream, more regulated, and easier to access. And this is something that a lot of people miss. These crypto ETPs can now be held inside of tax-efficient wrappers like your ISA or even SIPs, which massively changes the conversation. And I think SIPs is even the huger one when everyone's worrying about ISAs. You're not dealing with capital gains on admin in the same way. It starts to look a lot more like a small satellite investment rather than something on the fringes. Bitcoin actually has a fixed supply cap, which means there's a limit to how much will ever exist. That scarcity is a big part of the long-term argument for it, especially compared to currencies that can create more easily. Whether that plays out in the way people expect it to is still an open question, but it's a part of the appeal. From a skill point of view, crypto sits at the higher end, not because it's complicated to understand technically, because it's more emotionally difficult. The volatility can be extreme, prices double, half, or worse in very short periods of time. If you can't handle that, it will be very stressful. So when you add all of that up, this is how crypto scores. On return potential, it's extreme. The big upside is possible, but so are very large losses. On tax efficiency, it can actually be decent right now if you use ETPs inside an ISA or a pension. On a skill level, it's high, mainly because of behavior rather than knowledge. And on risk, it's very high. You have to be comfortable with that. And that's why for me, crypto is not something I would ever build my entire portfolio around. But as a very small controlled position, it can make sense for some people and maybe something I will add more to my portfolio of this year. But I do think with crypto, it has to be money that you wouldn't be bothered if you lost it anyway. The key is to not confuse long-term allocation with speculation. Small, intentional, and something you could hold without losing sleep. Everything we talked about has its strengths and weaknesses, and most arguments come online from people pretending that one option does everything when it just doesn't. What matters far more than picking the perfect assets is understanding what you're actually buying, how it behaves when things go wrong, and whether you can actually realistically stick with it over time. And that's why I wanted to rate these based on the return potential of risk and how suitable they are when you're starting from zero, rather than just talking about whatever has done really well recently. quickly. If you're new to investing, the biggest mistake I see is people trying to do too much quickly, jumping between things, chasing performance, or just copying someone else's portfolio without really understanding it. I would urge pretty much everyone to build the vast majority of your portfolio around index funds, and that's what I do. You don't need to be clever, you don't need to predict the future, and you definitely do not need to get everything right from day one. The most important thing to do is just start. Take your time with it and go away, think about what actually makes sense for you, and just start small. Because starting with something imperfect is a lot better than waiting forever for this perfect plan that will never come. If you want to see more about my portfolio and exactly what I'm holding to get some ideas, I've just posted this update which walks you through all of my accounts in much more detail, and I'll show you how I actually decide on what I hold too. I hope this was helpful. Good luck investing, and you've got this.